You can just feel it, right? The air around the tech industry right now.
Oh, absolutely.
It's just thick with tension. Everywhere you look, from major financial columns to, just casual conversation, there's one universal prediction.
The AI market is a bubble, and it's going to burst.
Exactly.
It's the ultimate cognitive dissonance, isn't it? I mean, we are simultaneously seeing this revolutionary technology, massive investment, while also just holding our breath, waiting for the crash.
Yeah.
The Australian Financial Review captured it perfectly. They said that if the AI market is a bubble, it's the most anticipated and examined one in history.
The most anticipated. Everyone is staring at the pop, waiting for the pop, forecasting the pop. Which brings us to our mission for this deep dive. We're exploring a fascinating hypothesis that you, our listener, brought up. Can this constant, widespread pessimism, this endless drumbeat of doom, actually function as a self-defeating prophecy? Can it prevent the very catastrophe it's forecasting?
It's such a powerful idea because it forces us to completely flip the script on market psychology. We spend so much time talking about the self-fulfilling prophecy.
Right, like a bank run.
Exactly. Belief in something makes it happen. The self-defeating prophecy, well, it works in the opposite direction.
Okay, so lay out the mechanism for us. What exactly is a self-defeating prophecy in a quantifiable sense?
Well, at its core, it's a prediction that because it is so widely believed and acted upon, the predicted event just doesn't occur. There's a related concept in risk management called the preparedness paradox.
The preparedness paradox.
Yeah, the paradox is that if you successfully prevent a disaster, the threat often seems overblown in hindsight. Because nothing bad happened, people assume the warnings were, just exaggerated.
So if a threat is visible and preventable, rational actors prepare, and poof, the risk is neutralized.
Okay, that makes perfect sense for physical threats, but I have to push back a bit here.
Okay. In the world of finance, isn't fear and anticipation of a crash usually what triggers the crash? Why would a generalized warning about an AI bubble make the market safer, instead of just making every investor panic and sell immediately?
That is the fundamental question of reflexivity, and to answer it, we really need to look at some historical examples where the collective response was successful mitigation, not just panic.
Give us the proofs.
Okay, we have two classic examples that really establish the concept. The first one is the Y2K bug.
Of course.
In the late 1990s, the panic was enormous. I mean, predictions of widespread computer failures, grid shutdowns, global chaos when the millennium turns.
And all that fear led to unprecedented corporate and government spending. Billions and billions of dollars poured into system upgrades preparation.
Right. And when January 1st, 2000 rolled around,
nothing happened.
Exactly. The disaster didn't fail to materialize because the threat was fake. It failed to materialize because the world responded rationally to the threat. The preparation defeated the prophecy.
And the moment the danger passed, everyone just forgot the danger was ever real. That's the paradox in action.
Precisely. The second proof point is the early warnings about climate change.
Okay.
Dire forecasts about worst-case warming scenarios spurred policy action, carbon taxes, renewable energy subsidies, and huge consumer behavioral changes like the global push toward electric vehicles.
And the source material highlights the tangible success there. Because of those actions, the worst-case warming projections have dropped significantly. They went from initial fears of, 3 to 3.5 degrees Celsius?
Down to the current projections of 2.3 to 2.5 degrees. The tragedy was averted, or at least substantially mitigated, because the warnings were taken seriously.
So mitigation is the key. Warnings don't stop the forces, they just force adaptation.
And there is a spectacular, very recent financial case study of this exact mechanism at work. The 2024 recession that was universally predicted, but never arrived.
This is so crucial for understanding AI. In 2022 and the early 2023, the consensus among economists was just overwhelmingly doom and gloom. A recession in 2024 was seen as almost certain.
And this is where we have to address that skepticism. By all traditional economic models, this should have been a classic self-fulfilling prophecy.
Right. Businesses anticipate a recession, so they freeze hiring, cut R&D, consumers pull back.
And that collective cutting should drag the economy into the very slump they predict.
We got the soft landing instead. So what were the counterforces? What was strong enough to break that traditional spiral?
There were two major shields that sterilized the typical vulnerabilities. First, the COVID stimulus buffer.
The stimulus buffer, okay.
Unlike previous cycles where the system was lean, governments injected over $6.5 trillion into the economy during the pandemic era. Think of the enormous boost to household savings, to corporate liquidity. It gave strong companies these really robust balance sheets.
So when the recession warning started, companies and consumers weren't forced to just slash spending to survive. They could afford to be cautious without collapsing.
Exactly. They were trimming expenses, not closing down. They were slowing growth rather than entering a free fall. That buffer was unprecedented.
Okay, and the second shield.
The timing of pessimism. And this is crucial. The worry arrived before the economic excesses could fully build up. In the run-up to 2008, no one was talking about a crash. Behavior was recklessly optimistic, leading to massive credit bubbles, over-leveraged debt.
But this time, the pessimism arrived early enough that companies never fully overhired. Credit markets never went into full-blown mania. Caution kind of sterilized the vulnerability.
And that collective early fear disciplined the highest level of policymaking. Because everyone, Wall Street, Main Street, politicians, was screaming recession ahead, it put this external pressure on the Federal Reserve. This widespread anxiety made the Fed pause tightening sooner and adopt a more measured, gradual approach. They were afraid of being the ones who accidentally triggered the predicted crash by over-tightening.
So the key insight here, linking back to the self-defeating prophecy, is that the fear of the crash changed collective behavior. It forced a controlled deceleration, a soft landing, instead of a violent crash. The timing was everything.
That is precisely the lesson we take to AI. Pessimism arrived before the euphoria could fully form.
Okay, let's use that timing insight and apply what I think is the ultimate psychological framework to the AI market. John Templeton's famous investment quote.
Oh, a classic. Templeton observed that human emotion dictates market risk. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria.
So if we want to know if AI is about to crash, we need to know where it sits on that cycle.
We can trace the path pretty clearly. AI was born on pessimism during the so-called AI winter of the 2000s when funding dried up and, public interest just waned.
Right.
We are currently, I would say, firmly in the growing on skepticism phase of 2023 and 2024.
Skepticism is everywhere.
Yeah.
It's the constant questioning. Is this really revolutionary? Is it just sophisticated autocomplete? Will it ever generate actual revenue beyond these massive training costs?
And this is where the self-defeating prophecy finds its anchor. The final phase, die on euphoria, is currently missing.
Missing.
Completely. True euphoria means ignoring the risks and believing this time is different. When even key industry leaders like Sam Altman publicly admit that the sector looks like a bubble, that is not euphoria. That is profound anxiety baked into the consensus view.
And the data supports this. I mean, the spending is massive. We were looking at, something like $400 billion projected for AI infrastructure this year. But the warnings are not being swept under the rug. They're being amplified.
Think about the detail the market is paying attention to. Bank of America's survey identified the AI equity bubble as the top global tail risk for investors.
Yeah.
And you have these findings from MIT researchers that 95% of corporate generative AI projects have failed to generate meaningful financial returns. This is widely reported. This is not the behavior of an optimistic market looking away. It's a highly critical market scrutinizing every single dollar.
The NVIDIA example is a perfect illustration of this skepticism. NVIDIA reports revenue soaring 62% year-over-year, a spectacular result.
Unbelievable numbers.
And yet, the stock falls almost 6% the next week, and eventually 15.7% from its peak.
That kind of decline, despite stellar fundamentals, is the opposite of euphoria. In a true bubble, that stock would shoot up regardless of any underlying risk. Price would be governed by hope, not fundamentals.
But here, it seems like the price is governed by fear that the company can't possibly justify this growth rate forever.
Or that competition will catch up. Investors are anticipating the pop, which just lowers the threshold for selling.
That deep investor awareness really is the key defense mechanism. Which brings us to the crucial contrast with, the ultimate bubble.
Yeah.
The Dotcom crash of 2000.
The Dotcom era was just defined by pure, unadulterated euphoria and FOMO. Warnings about valuation and profitability were largely muted or just outright ignored.
And that systemic blindness is what led to that devastating, 78% NASDAQ drop?
A complete wipeout, but AI is fundamentally different.
Not just because the tech is more mature.
Correct. The sentiment is different, but so are the fundamentals behind the spending. Dotcom had a huge number of companies with zero revenue, relying solely on speculative investment.
Right.
AI's high spending is largely driven by companies that are immensely profitable giants. Microsoft, Alphabet, Amazon, Meta. They are using cash flow from existing highly lucrative businesses to fund AI. This gives the underlying market far more resilience.
Okay, so how does this pervasive caution translate into a self-defeating prophecy, specifically for the AI market? What's the practical difference this constant fear makes?
It creates two institutionalized defensive mechanisms.
Yeah.
Mechanism number one is capital allocation discipline. Because VCs, private equity, boards, they are all constantly being warned about the bubble. They can't just throw money recklessly at every idea with AI stamped on it.
So how is that discipline enforced in practice?
Investors are demanding clearer and much shorter paths to profitability. They're asking, how does this generate net income in 18 months, not just user growth in 5 years? This intense pressure forces companies to justify their spending with real-world cash flow projections. This scrutiny prevents the catastrophic over-leveraging and overbuilding that kills bubbles. It replaces blind hope with disciplined skepticism.
So instead of companies growing faster than they can manage, they're constantly running this internal audit that's dictated by the fear of a crash.
Precisely. And that leads to mechanism number two, the soft landing likelihood. The consensus view is that this constant vigilance means we avoid a 1929-style systemic crash where the entire financial system just locks up.
You get a correction, not a collapse.
Instead, the self-defeating prophecy guides us toward a painful but survivable 2002-style decline, where the overvalued speculative parts of the ecosystem unwind gradually, but the core technology and profitable players survive to build the next iteration.
This has been an incredible exploration. When we synthesize all this, the truth about the AI market is, well, it's complicated.
It is. The intense, incessant bubble predictions are the very force creating the defensive behavior that prevents full-blown systemic mania. The self-defeating prophecy is working right now by keeping us all sober.
But we can't just declare the danger over entirely.
Oh no, we still have a massive fundamental gap between the incredible investment, that $1 trillion being allocated, and the relatively speculative financial returns. A correction is highly likely because the market math has to normalize eventually.
So the warnings are what's holding it all together.
The persistent loud warnings are paradoxically what are preventing the rush toward a total chaotic disaster.
So, if constant predictions of collapse are ironically stabilizing the market, what's the single most important signal for you, the listener, to watch for? What tells us that the crash is truly coming?
We have to return to John Templeton's full framework. The ultimate contrarian signal might not be when the bubble predictions start, but when they stop.
When they stop.
Right now, the market is growing on skepticism. The only prerequisite for that catastrophic systemic crash is the final missing stage, euphoria.
So you should tell yourself this. If the constant doomsayers and bubble predictors suddenly go quiet, if every analyst on the news starts to echo the phrase, actually this time is different, the risk is minimal, and we are entering a phase of limitless, unstoppable growth.
That is the moment the market has lost its discipline. That is when you should seriously look for the exit.
Because that silence, that will be the sign that true mania, the prerequisite for a catastrophic crash, has finally arrived.